Welcome back, everyone. This is Alvin Fan. I'm the CEO of OP Investment Management. Joining us this week is a very special guest, Mr. Michael Wagner, founder of Star Atlas, one of the most well-known and I would say the OG game developments in the crypto space. Most of us who have been in the digital assets realm have really been keeping close tabs on what Star Atlas has been doing, especially after the breakout success of Axie Infinity. A couple of years afterwards, when Star Atlas was released, it made a huge waves in the market and actually was one of the reasons why Solana became such a successful chain. Even in the recent rebound in Solana, Star Atlas was a very important component in improving the high transaction flow that Solana was able to handle. But before I jump into it, Michael, it's really, really good to see you again, and thanks for joining us.
Alvin, it's a pleasure to be back. It's been a couple of years since we had a conversation like this, so really looking forward to the discussion here today. And you just covered a lot there in the intro. Can't wait to dive into that.
I know. I'm pretty excited. Last time we sat down together, you had just finished your TGA, I think roughly 9 months or so. You've been hiring the team, building out your dev set, and you had already started work on early iterations of different forms of the Star Atlas universe, the game, etc. A few months, or at least, no, I wouldn't say a few months, a year after that, roughly 9 months after that, the FTX debacle came in, the Luna crash. Star Atlas was in a tough situation. FTX, when they collapsed, they were actually holding treasuries of several, if not many, of the Solana projects, including Star Atlas. So I do want to dive into it. You're in a great position now, but I do want to go back to that day and maybe the 30 days following the collapse of FTX. What was that like for you as a CEO, as a founder, especially coming off the success of a very big TGE? What was that like for you with the team? And then we'll jump into the granular details.
I would love to address that. I do want to go back in time a little bit to 2021. You were talking about our TGE, the token generation event, and the course of and the building of our company and our team over 2021. I just want to preface my response to the FTX event with information I think not a lot of people are really aware of, and that's that Automata, our studio behind Star Atlas, we've bootstrapped all of the funding and growth and development of this game since inception. We've not ever taken on venture capital. We actually were quite fortunate and quite successful, I would say, in being able to present a vision to the global crypto community and captivate interest and attract dollars in the form of spend. People purchasing could be tokens, but also our poster series and getting into a lot of our digital assets, our NFTs. And we had some enormous success. Our first year of business was $150 million in revenue. And I only want to lay the foundation with that number because FTX was, in fact, quite impactful to us. FTX was a $15 million loss to our company and to our studio. Now, relative to the amount of revenue that we've generated through time, which is now in excess of $200 million, 3 years running, you wouldn't think $15 million is all that much money. And it really isn't, again, relative to revenue, with the exception of 2022 itself was a pretty horrendous year in crypto. You had noted Terra Luna, that was one example, BlockFi, Celsius, Three Arrows Capital, FTX, all of these so-called black swan events taking place in a singular year, and I think it in many ways cascading down and causing additional collapses and implosions of various companies like FTX. For us, a big component of our revenue actually comes in the form of our own native token, Atlas, which is the in-game currency. It's the way that people earn throughout our gaming ecosystem. And being very early stage as we were, one of the few utilities we could provide for that token was to open up our marketplace and asset sales in the form of that token. And I had taken the position, which I still support, although perhaps could have executed better in hindsight, but I took the position that we would not be selling any of the tokens that we collected in the form of revenue until we delivered material product development and we could justify that We were here to stay, to build something real. It wasn't a scam. It wasn't a fraud. We weren't trying to rug people, which would have been the immediate accusation if we were selling those tokens. And so the larger impact to our balance sheet was realistically through holding these token balances, which ultimately declined in value by $65 million. And again, I'm kind of building up to the FTX event. So 2022 was a bad year. Crypto was collapsing. Our token pricing was taking a hit. So effectively, we were seeing a reduction on our balance sheet as a result of that. And then FTX comes. We had a pretty decent cash balance, but our goal and our vision has always been to build this AAA game and really a gaming platform and a gaming ecosystem. And we can kind of dig into that. But we started with a team of 4 people, co-founders, and we scaled our business to accomplish that goal of building a AAA game. We scaled our team up to 235 people. We were spending around $2.5 to $3 million a month on any given month as a result of that. And then, as I said, FTX hits us, and this was cash balance that was really essential for us to continue building through the bear market with the team that we had established. And it was rough, and it was really bittersweet. I don't even know if I'd say bittersweet, but using that term, it was tough because it happened at Breakpoint in 2022. Breakpoint is Solana's big annual conference, and I had given a keynote there, and our community and the Solana community were just elated with what we had presented, what was coming up. And I felt so good following that keynote presentation. And it was only a day or maybe 2 days later that the realization hit that, oh man, FTX is going under. We have this money on the exchange, and there's effectively no way for us to recover that right now. So it was pretty devastating. And immediately coming back from Lisbon in 2022, coming back from Lisbon, let's get together in the war room with the executive team and figure out what we need to do. And we set to action. And that was the first time really in the history of the company that I wanted and needed to raise capital to ensure that we could maintain the team. But that's ultimately not how things played out. So let me pause there and maybe we can dive deeper into it.
So walk me through, because this is a critical point. And for every entrepreneur, there's going to be a period in that cycle on the presumption that, of course, we're going to make it out to the other end, that we need to tighten our belt. A lot of founders in the private market, not necessarily crypto, were actually going through something similar as interest rates were coming up and the economy went through a major risk-off cycle. And we weren't just seeing this in digital assets. We were seeing this in consumers, seeing this in Asia. We're seeing this in privates where secondary markets, they were being sold off at tremendous discounts to cash or to book to a VC entry values. So a lot of that was happening out in TradeFi. This is definitely accentuated in your environment. Similarly, I imagine you had to go through a workout. So what did that look like? You just came off hiring over 200 developers. You're spending millions in a month, but you still need the CapEx in order to generate and to develop the output you need to build to the next stage of both the economy and the game deliverables. What did you do? What happened at that point? And what was it like to work with teams who started with great promise?
Well, the first step was to take a pretty deep assessment about what type of reductions we should make across the team. And I wanted to be as conservative as possible. So the first step we took going into the end of the year was to execute a 13% reduction of our team across the board. And we were selective in the positions that we eliminated in that round. But to your exact point, and particularly in our case where we need to develop product and have releases to continue driving enthusiasm and interest in the game itself, which translates into asset sales, which had already declined quite substantially over 2021 and really especially by the tail end of 2022. We also were in a tight position because we're holding quite a significant balance of assets on our balance sheet, but token prices are now at, effectively all-time lows. However, we had a decent cash balance on the balance sheet, and I knew that I could get us out a good 9 months to possibly 12 months with a small reduction. But that was under the assumption that we would see some improvement in markets in 2023, which really did not happen. And also that we would deliver and execute on some of the releases that we had on our roadmap. We also ended up falling short in that case as well. But it was a small reduction in December 2022. And it was really a rally cry to our team internally to say, hey, we're going to do this no matter what. We're not quitting. We're not stopping. And we need you all to be with us, to support us and give everything you can right now so that we can continue the dream. And everybody really did rally up, but we still were not able to hit those milestones that we had of getting quick iterative releases out that demonstrate to people what we're capable of and what the future can look like. And so we really stayed the course. Also in December and for the first 6 months of 2023, I took dozens, if not hundreds of calls with venture capital groups. But as you can imagine, the risk profile of the company and just the current sentiment in the market in general, following all of these major events of 2022, it was very difficult to raise capital. Ultimately, I was not able to raise capital, and I had hoped that we would do that in the first half of 2023. And so ultimately, this led to a second round of reductions in July of 2023. But for us, it was cutting costs where we could. It was even little things that you might not expect, but subscription fees of various software as a service, that is easy to get bloated over time because team members request access. You start adding people. Before you know it, you're spending $100,000 a month in software fees. So we trimmed down where we could.
I think we have 6 or 7 software as a service subscriptions that first start off with, it's only $20 a month per user, but we have an employee base of over 30. And then there's the add-on. Suddenly that bill works out to tens of thousands of dollars a year. Multiply that over 6 or 7 programs. It's a tough conversation when you sit down with your CTO and be like, look, do you really need this tech stack, right, that you could do on Excel? Do you really need this communication stack that you can do over Bloomberg chat, right? I totally understand. Going back to raising capital, and I think it's great that we can have this conversation now. One thing that we've observed for a lot of teams, the philosophy of Star Atlas was to try as much as possible to raise capital from the market. And by the market means through organic generation of revenues, through sales of NFTs, which I'm kind of imagining now was great in year 1. And then it went through a basically 0 revenues and then it was fantastic in the last 6 months, just observing how the market is. So the hardest part was definitely in the middle when there was no revenues and you had to raise capital in the most difficult environment. Now, at that point, it sounds like you had to make a philosophical decision to tap into the VC network, which is something that you were resistant to before. So what are your reflections now on working with VCs? Now, I wouldn't call it a I told you so moment where you say, hey, look, all those VCs who said no to us 6 months ago, 9 months ago, we're doing just fine now. And you had potentially missed out on a great opportunity. But at the same time, there's a lot of learnings from this type of situation. Would you be open to VC investments moving forward? And what would that structure look like? So let me start with that question first, and then we can talk about the deal structures.
Alvin, I think you know my background, CFA charter holder. I worked in investment management before really committing full time to crypto. So I definitely understand the place that VCs or PE holds and capital allocation and, the growth potential of companies by taking on investment and what's feasible there. So I don't want this to appear as an egotistical response. Hey, we bootstrapped the company. We did it all on our own. We didn't raise any money. It's not like that. For me, it really is more the fact that we have this more, almost a humanitarian vision for Star Atlas, wherein the DAO ultimately takes control of the IP. And of course, we as an organization, we have a substantial ownership over the DAO as well right now. But it's such an unconventional model that I think it is a tough sell for a venture capital group, where obviously your business model is, how do we get return on our investment? What do we tell our LPs, right? You guys need to generate a return if you're putting money into anything. And if I go out and say, hey, we're going to turn the IP now over to the DAO. Now, I have a full model and a full vision behind this and how that can actually generate cash flows for us in perpetuity through some type of rev sharing model. And I think that's fair because we are the ones putting the work in, the labor in, we develop the vision, and we're bringing the product to market. So I think that's ultimately fair long term. But I just think that's a difficult conversation to have. And I think that, again, it's so unconventional. You don't ever see businesses build up great IP. We were just talking about your coffee mug, by the way, the Star Wars coffee mug, right? You wouldn't see Disney go out and say, hey, now it's freely open and accessible to anybody to build with. And that's so important to me and so critical to me that it does make me resistant to raising venture capital. because I like having the autonomy and the control over the company to operate and execute in the way that we think it's most appropriate, and that is holding true to the way that we presented it all the way back in the beginning.
Through different smaller VC groups, I also participated in other game development, sort of the strategic rounds. We work with some of the larger exchanges and advisors as well. I'm noticing something that's inherently different in Web3 gaming fundraising than, say, traditional VC. VC, when we look at the philosophy of it, is long-term by nature. Strategic financing comes in, it's locked-in capital, it's semi-permanent to the extent that you're not going to have a conversation about valuation well until many years down the road, so long as certain IRRs or certain milestones are hit from a company development perspective. But I find that in Web3, because of the liquidity profile of tokenization, I wouldn't say now they're spoiled, but VCs are now expecting very, very shorter term ways of, or at least early means of having some return on capital, simply because the explosiveness of the valuations or explosiveness of the market distributions are so high. And so even with the deals I'm looking at recently, you might look at like a 6-month or 12-month lockup with a cliff and then 10% unlock of the TGE at TGE. They're assuming they would get 10, maybe 20x on TGE, or at least 5, so they can recover some of their costs and the rest would be a relatively free ride. You don't see anything like this in traditional finance, in a traditional VC world. And so the conversation becomes even harder because of the expectations of those types of returns, right? Where are you going to get 20x returns in 12 months and 6 monts in TradeFi? You don't, right? So even for those of us, including yourself and me, who come from a finance background, it's mind-boggling, but it's become almost I wouldn't say a minimum requirement, but something that they expect. So if you don't have that, then it's even harder to raise capital. What are your thoughts on that in terms of, does this give you more impetus to drive revenue generation and financing through, I would almost look at it almost like a real estate type of a model that we have here at Star Atlas, where you're selling off the plan, you're showing this is what's going to be built, here are the assets that are going to be potentially revenue generating that can be part of the game asset and the ecosystem, but you're buying in advance. Right? We're going to give you some utility in the beginning, but you're kind of buying in advance. It's like off-plan selling a property. And the risk then is really an execution risk of the development of the building moving up. But that's financing that still works. But even property developers still need some form of financing or leverage from the bank in order to get through the development cycle.
I think the scenario that you described really applies primarily to our user base, to our community, to the customers of Star Atlas. These are the people that are looking or reading through our white paper, through our economics paper, and purchasing assets from us now with the anticipation of those assets being delivered and the gameplay mechanics being delivered in the future. I will say that was largely a dynamic that existed in the earliest days. The items that we have on market today now all do have utility in some form or fashion. They have a way to generate revenue or to produce assets or produce materials that are used in gameplay. So, and we're pretty careful and cognizant about releasing any new asset that doesn't have immediate utility behind it, given the traction and how far we've come along. From the venture capital standpoint, I also fully appreciate that our business would be a difficult one to assess and analyze for making an investment. Again, looking at something like revenues, which I noted upwards of 200 million and beyond now, but one that also has a fairly weak, I'm referring to 2023 now, one that has a fairly weak balance sheet following the FTX event, has a very high run rate and revenues that are low at the time and very volatile. And then one of the questions that I received on, I think every single call I took was, well, how does the value accrue? You have two tokens. You have a governance token, you have a game currency, you have all of these digital assets, these NFTs you're selling, and then you have equity and you're raising capital on equity. And we were open to structuring hybrid deals where, hey, you'll get some tokens and equity in the company. But landing on a valuation that seemed reasonable, given the past successes that we had, but also our current situation, I think was very, very difficult. And also knowing that the reality is our production cost on Star Atlas to bring the full vision to life is probably $350 to $400 million. I mean, this is astronomical. It's more, you could probably produce, 2 Hollywood movies for that, right?
I was about to say, exactly.